A big week of earnings reports ended with a whimper from two tech giants that had been lifting the markets. Apple and Amazon both are down on disappointing results and warnings about labor shortages and supply chain issues. The two companies put dollar figures on those constraints. Amazon's CFO said labor costs rose $2 billion last quarter. He attributed nearly half of that to inflation. Apple's Tim Cook said supply constraints in the last quarter cost the company $6 billion in sales. Dan Ives is the managing director of equity research at Wedbush Securities, and he joins us from Westfield, New Jersey. Great to see you.
Great to be here.
All right, Amazon and Apple, we've got a theme running here. First of all, they're the darlings of Wall Street, but in their earnings, they are being hit hard by supply chain issues, something they had really escaped in the past. Do you think investors are overreacting?
Look, and the supply chain issues continue to be the black cloud over tech as well as the auto sector. Look, I think Apple and Amazon, they've almost been Teflon-like. So for them to get hit to the extent that they did, that was disappointing. But I continue to view this as transitory in terms of my view. These are still names you own. I think it's short-term sort of headwinds as the demand continues to outstrip the supply.
Okay, Amazon badly missing on earnings and revenue, plus its fourth quarter sales guidance below what Wall Street had expected. That did surprise Wall Street. It does seem a little bit familiar, though. If you remember years ago, there was a disconnect between what Amazon's numbers were and analysts' expectations because the company was in kind of an investment mode. Do you think that's part of what's happening now with Amazon?
Well, also, I think the level of expenses it caught the street by surprise in terms of labor. Everyone knew about freight and supply chain, but I think overall the cost that we're seeing, is definitely much more elevated. And you bring up a great point. When you go back to those few years ago, the street was fine with Amazon investment mode. Now they want to see those margins continue to increase. That's the key to the stock moving higher. That's why you're seeing definitely, stock take a breather here as Amazon's a little bit prove me going to holiday season. It seems like the supply chain could ultimately crash the holiday party.
Apple, let's turn to Apple here. The chip shortage, global logistics, all those headwinds costing Apple $6 billion. Talk us through how Apple gets past this as this, the supply chain issue you say is transitory. It's really not going away anytime soon.
Well, remember, Apple always gets the front of the line, just given the biggest technology manufacturer out there, especially coming out of China. But right now, they're about 10 million iPhones short relative to demand. So the average consumer, if they order an iPhone anywhere after Thanksgiving, they will not be getting that by Christmas or holiday season. I think the way Apple gets through this is ultimately it starts to moderate in terms of supply chain into January, February. But right now, demand continues to be massive. I mean, China's up 80% year over year. That's why the stock is not selling off to the extent that you'd think it would, because demand continues to outstrip supply. And I believe this is a $3 trillion market cap going into next year.
All right, let's switch gears and talk about the big three names in cloud, Microsoft, Google, and of course, Amazon, which reported. Do you think chip shortages could slow growth in this area?
Well, I think ultimately that's a little more resilient in terms of cloud. That's why Microsoft, you saw it overtake Apple is the most valuable company in the world because it's a cloud arms race going on right now. Digital transformation, that's a $2 trillion market. I think Microsoft and Amazon, it's a two-horse race, but Google, IBM, and others are benefiting. And that's not really susceptible to the chip shortage because it's software driven. So I think what you're seeing more and more investors rotate to names like Microsoft. That's almost a safety blanket name going into year end.
Do you see opportunity in the tech area for investors?
Oh, I believe it's a green light here to own tech. I mean, in my view, we're only in the middle innings of a re-rating in tech stocks. We think NASDAQ's up another 15, 20% next year. So I view this breather to own some of our favorite names, the likes of an Apple, a Microsoft, cybersecurity names, despite chip shortage, because it's our view that's just transitory. And on the other side, you're going to see pent-up demand. And I think that's sort of the 1-2 punch that drives these stocks higher.
Okay, Dan Ives with Wedbush Securities. Thanks so much for your time.